So I want to start right there because this was a record fundraising round. We know there was a lot attached to this fundraising round, including a promise of a conversion to a for-profit entity. Why did you feel it was compelling to invest now and at this valuation?
Well, we've been doing work on AI for 10 years, and we've been waiting for the companies that were really that Nvidia was going to hand the baton to. Not that Nvidia's story is over at all, but as you know, Nvidia has basically been communicating, and investors have been buying a very big idea. And for Nvidia to continue to work, we think there are going to be other winners. We think that the foundation model players are going to be very big winners, $15 to $20 trillion in market cap in the next 5 to 10 years. We put out a piece in our Sunday newsletter you can find on arc-invest.com, and we're going to put out a lot more on this. So OpenAI leading the charge, really, Anthropic, XAI, so Elon Musk and team, and even Elon, I think, is saying those three, and Google with Gemini are the big four. And, you know, unlike the railroad era, when many people are comparing this to the railroad era, I think that the four winners are showing themselves very quickly. Whereas in the railroad era, which, by the way, accounted for 63% of the stock market in its heyday in the early 1900s, unlike the railroads, there were hundreds. I think there were hundreds. We can focus on the big winners. This space is moving so quickly and is going to become so big because it's effectively substituting software for labor. Not that this is going to kill jobs at all. It's going to make people much more productive. And they're already seeing it with ChatGPT just as a starter.
And of course, the four companies you just mentioned are all companies that you are invested in through your funds. I mean, you mentioned XAI. It's been interesting because Elon Musk, co-founder of OpenAI, has been very vocal, very critical of where OpenAI is headed and the direction in which Sam Altman is taking it. Do you disagree?
I think what he's talking about is more about the history of the company, and we're looking at the future. And I was happy to hear that he did mention, of course, OpenAI as one of the leaders. Of course it is. So, you know, we're just looking to the future. I know there's a history there, and, you know, what's done is done. And we're just looking forward, trying to figure out who are going to be the big winners in this space.
Microsoft has just unveiled a game-changing investment that is sending ripples across the tech industry. The software giant announced its plan to spend a staggering $80 billion this year on data centers aimed at boosting artificial intelligence models and cloud-based applications globally. This move positions Microsoft alongside key players like Nvidia, setting the stage for a potential paradigm shift in AI infrastructure. The investment surpasses the GDP of several entire countries, marking a bold strategic gamble that has left the financial world buzzing with speculation and anticipation. Welcome back to Investocracy.
Cathie, I want to look back at the innovation fund for a moment. Over some periods of time, see the S&P is up 34% over a year, beating ARC Innovation by 14 points, 94% over 5 years, beating that fund by 84 points, 191% over 10 years. That's for the S&P, beating the Innovation Fund by 64 points, pretty much since inception. What do you say to investors who look at that performance and doubt that you're making the right calls?
Yes, I would say, first of all, our compound annual rate of return since inception has been nearly 10%. We went through a boom in 2020 during COVID, where we were up 360%. And we had valuation and interest rates and concentration in the markets working against us. We are a diversified exposure to innovation, truly disruptive innovation. I would focus people on the fact, and looking at your chart there, that if you take away that boom and bust, what we have now is three forces working for us and a long base. Again, you take away, you can say we have a base after that period. You can look since 2018, we've been basing. And I remember saying this with Tesla at the time. The longer the base, the bigger the breakout. And we certainly were right there. The three forces that I think are going to become tailwinds now, they have been headwinds. Interest rates, they're coming down. And I think they're going, despite what we saw in the employment report today, I do think that they will come down more than people think during the months ahead. The second is the concentration in the market towards the Mag 6. That is starting to dissipate, and I think that will work in our favor. And then the third is valuation. During August, when the market got hit, our valuation, as measured by enterprise value to EBITDA, dropped to nearly a market multiple. We were basically sitting on a market multiple at 21 times EBITDA, enterprise value relative to EBITDA. Now, we do adjust it for stock-based compensation, which is really important when it comes to innovation, alignment with shareholders, as well as normalize R&D. But that valuation typically is twice the market's, and we hit the market. So now I'm looking at what were headwinds turning around and becoming tailwinds.
The news of Microsoft's massive $80 billion commitment to building data centers is more than just a headline. It's a defining moment in the tech landscape. Delving into the details, it's clear that this move will reinforce Microsoft's dominance in AI, with approximately half of the investment allocated to the US alone, effectively strengthening its Azure cloud offerings. However, Microsoft isn't alone in reaping the benefits of this ambitious infrastructure expansion. Nvidia stands to gain immensely, with Microsoft being its largest customer, responsible for purchasing an astounding 485,000 GPUs in 2024 alone. It's expected that 2025 will witness even greater investments in Nvidia's offerings as the insatiable demand for computing power persists. But before going on with the video, are you into cryptocurrency? If so, check out our second channel, Investocracy Crypto. We bring you breaking news, expert analysis, and the latest trends in the fast-moving world of digital assets. Whether you're a seasoned crypto investor or just curious about the future of finance, we've got something for you. Click the link in the description to subscribe to Investocracy Crypto now. Don't miss out and stay ahead of the game. Now, let's get back to the video.
Greetings, everyone. Well, we have more clarity now in terms of the investment landscape after the election. And I wanted to talk a little bit about deja vu for me. I started my career really in the early 80s. And at the time, we had the Reagan administration and a lot of controversy about everything, much of which we're hearing today, the same kinds of controversy. So I wanted to take you a little bit through the macros, what the Trump administration says it wants versus what might likely happen given that backdrop, as well as how this clarity is going to impact the world of innovation, the world of transformative innovation. And we believe the world is transforming and in miraculous ways. So we want to take you through some of that and how this administration, its policies are probably going to accelerate these changes. So let's talk about macros first. In the early days of the Reagan administration, there were back-to-back recessions and interest rates hit 15%. And that was a very difficult environment for investing. Well, President Trump is coming into office when that part of the equivalent in the Reagan administration has been done. And I remember after that, the 80s and 90s were the golden age of active equity investing. And I think we're going back there. First of all, in terms of the controversy, a deficit back then, after back-to-back recessions, 5.5%. The bond market was apoplectic about that. Investors were as well. And what they didn't understand is that the Reagan policies of tax cuts, along with lower interest rates caused by Volcker, moving from double-digit interest rates to something much lower, that those were going to be very positive for economic growth, and that we were going to grow our way out of the deficit. That growth out of the deficit started in the 80s with the Reagan administration and finished in the 90s with the Clinton administration, taking us into a surplus. We think we're going to experience somewhat of the same thing this time around. The tax cuts, we believe, are critically important, especially if Trump makes good on his tariff promise. Now, I'm not a big fan of tariffs myself, but if we're going to pair tariffs, not on our free trade partners, but on those countries that really are not giving American goods and services a level playing field, but we counter them at home with lower tax rates for consumers and businesses, that's a trade-off. That's a good trade-off. And so I don't think the criticism about tariffs is going to play out in terms of 100% across the board. That's not what we're talking about here. I think President Trump is very pro-growth, and he's not going to do anything to impede growth in that way. He wants the dollar down. He thinks that will make us more competitive. What I think will happen is the returns on invested capital in the United States relative to those elsewhere in the world, they're going to increase, and that is going to attract more capital, which will actually boost the dollar. Now, in terms of interest rates, the dollar going up is anti-inflationary, as is the productivity growth associated with a burst in activity caused by lower tax rates and other incentives for investing. So if inflation is going to surprise on the low side of expectations, that's going to be very good for innovation-driven strategies.
The ultimate question remains, should you dive headfirst into Nvidia stock? With Microsoft's substantial investment, there's a high probability that Nvidia will see unprecedented growth in 2025. The stock currently trades with an enticing forward price-to-earnings ratio, promising considerable returns that few stocks can boast. Moreover, the price-earnings-to-growth ratio suggests Nvidia is undervalued, representing a unique opportunity in a market that often aligns with the adage of the early bird catches the worm. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
If we believe tax rates are going to come down, we're probably going to wait if we're businesses and consumers. This is classic. It even happened during the Reagan administration when he phased in tax cuts over 3 years. Most people just waited until the tax rates were at the point he had promised. So we probably will see some holding back of activity in the next year in anticipation of even lower tax rates. So I think interest rates will be biased to the downside. Thereafter, I think we're going to see an explosion in productivity growth. That's what the convergence among the major innovation platforms around which we've centered our research. So robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing in the healthcare space. Those platforms are converging and we believe are going to unlock explosive productivity growth, explosive GDP growth, and much lower than expected inflation because all of these platforms are deflationary. They're technologically enabled.
We eagerly pose the question to you. How do you interpret this staggering investment and the potential ripple effects throughout the industry? Share your thoughts and let the debate begin. And finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.